is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Good morning and welcome to Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Here's what's coming up on today's programme. ASML forecasts better than expected second quarter sales, even as order intake lags. In the US, we await Morgan Stanley earnings after Goldman Sachs misses out on Wall Street's fixed income trading boom. UK inflation unexpectedly stays above 10%, cementing bets the Bank of England will hike at its meeting in May. Plus, the chief executive of UniCredit, Andrea Ocel, joins us in conversation at the New Economy Gateway, Europe. Let's check in on these markets then. You're lower across European equities as way up the earnings front, but also the commentary from Fed officials and the data coming through from the UK on the pain of inflation. European stocks down 0.2%. James Bullard saying he wants to see potentially 5.75 in terms of the terminal rate from the Fed. You're currently at the top end at 5% on Fed rates. 5.75 as the market priced for rates at that level. That is a question maybe being posed across these markets. Futures in the US now down by 0.3%. We continue, of course, to focus on the bank earnings with Morgan Stanley coming up later today. And we're going to unpack that story in more detail for you. The US 2-year, 4.25, yields moving higher. And that's having an impact across the technology sector. 5 basis point move higher at the front end, 4.25. It's even more aggressive when it comes to UK gilts. And again, we'll touch on those just in the next couple of seconds. Brent at $83 a barrel, falling 1%. This will be tied, no doubt, to concerns about recession risks as inflation remains stickier. And central bank officials from the ECB to the Fed really cement views that hikes are going to have to come through higher and possibly for longer as well. Let's check in on those UK assets then, because you had a big move in terms of the pound versus US dollar and euro, but also, of course, repricing around expectations of further hikes from the Bank of England. Let's remind ourselves, we're in a different category now here in the UK. We remain in the double-digit camp. It's not the same picture in the Eurozone. It's not the same in the US, where CPI is at 5%. We are the outlier here in the UK, and we're having to reprice what has already been an aggressive response of the Bank of England. Expectations that you get hikes now from May and June. We're at 4.25 now. Market's starting to price in 5% as the top end from the Bank of England. There's the move in the gilts. Bear flattening from the 2s to 10s, yields higher by 12 basis points at the front end, 381. The 10-year, 382. Let's check in pre-market. Of course, a big week for earnings. Netflix coming in with subs that disappointed to the downside. Subscriptions came in lower than expected, but then pricing started to change on the update and the outlook. So you saw a 12% drop pre-market. This is the pre-market move now, down 0.6%. Again, on the outlook, looking a little bit more positive. A lot of that is going to be contingent on their hopes that the password crackdown is going to pay dividends in terms of getting more people on to this streaming platform. So that's the Netflix right now, pre-market down 0.6%, really pairing significantly the heavier drop that we saw immediately after those results. Let's get to banking, though. Goldman Sachs traders failing to capitalise on the fixed income bonanza that the rest of Wall Street generated last quarter. Question marks, arguably, for the CEO. That included rival Bank of America, whose fixed income traders beat pretty healthily the estimates in their first quarter earnings. Let's bring in Charlie Wells, who's been across all of the details when it comes to banking. Charlie, set the scene in terms of Goldman Sachs and the challenges around fixed income, particularly when it comes to their rivals.
Yeah, this is really difficult. It's been one of the most dramatic and perhaps surprising earnings seasons for Wall Street banks in a long time now. You saw this surprise with Goldman Sachs. Fixed income trading revenue for the first quarter down 17%. That makes them the only large Wall Street bank to have reported so far a drop in that division. So contrast that with Bank of America. There was another surprise, but it was a surprise on the upside, a 30% growth there in that fixed income trading division. So that is very good news for the CEO of Bank of America. More good news on net interest income as well as deposits. So this earnings season has certainly posed a lot of unexpected changes following that drama that we saw in March with U.S. banks.
It's just worth pausing on that, isn't it? 30% increase for fixed income for Bank of America versus a contraction of 17% for Goldman Sachs. Morgan Stanley coming through later. Are they going to fall in the Goldman category or the Bank of America category?
So Goldman's not going to like us. I mean, Morgan Stanley has been performing very well in the markets this year. Their share price is up 6%. When you look at the S&P 500 Financials Index, it's down 3%. So Morgan Stanley in good standing with investors right there. You know, one of the differences here, though, is Morgan Stanley focuses more on equities trading as opposed to fixed income. So that may not bode quite so well. We know from some Jefferies data that trading in equities for the industry at large has been down 7%. So potentially not as much of a boost there. But I'm really focused on wealth management. That is something that really has made Morgan Stanley a darling of investors. They've really been able to pivot to that over the years, get that fee income coming in, that revenue coming in when markets are good and when markets are bad. That could provide a boost.
They were ahead of the curve, well ahead of the curve. The likes of Credit Suisse rushing to build out there, but the likes of Morgan Stanley well ahead of the curve in terms of building out that asset management, wealth management part of the business. We don't normally care about regional banks in the US, frankly, but given what's happened in the last few months, we do this time. Can we take any reassurance from what's happening at Western Alliance?
You know, we really can. So we saw as much as 20% of an increase in the share price yesterday for Western Alliance. That is a Phoenix-based bank, which we don't necessarily focus on here from London, but these banks were really at the center of that March madness last month when there were concerns about deposits. Deposits came into focus yesterday with Western Alliance, saying that they had actually seen an increase from the end of that turmoil, March 20th, to April 14th, so just last week. They saw an inflow of $3 billion. So that is reassuring, and that was reassuring for the markets yesterday for their share price.
They're obviously doing something right, aren't they, to reassure their clients. Really appreciate it. Charlie Wells, of course, with a preview of Morgan Stanley, and, of course, the resilience that we're seeing, at least for now, across some of those regional lenders. Tensions, of course, in the financial sector, supply bottlenecks and energy prices, well, they have all eased, but a more detailed picture of inflation is needed. That is the view of the ECB chief economist, Philip Lane, who sees another rate hike in May. He spoke to us at the Bloomberg New Economy Gateway Europe conference in Wicklow in Ireland.
Q1 suggests we are seeing a reversal of the negative supply shocks that so dominated the European economy last year. So easing of bottlenecks, much lower gas prices. So what I would say from all of that is, as of now, 2 weeks away, I think the baseline is that we should indeed increase interest rates in May.
OK, the ECB's chief economist, Philip Lane, on the expectation that you will get another rate hike from the ECB at the next meeting, at a time, of course, when markets are now pricing in, when it comes to the Bank of England, another hike, not just in May, but also in June as well, with a terminal rate at 5%. We're currently at 4.25 on the Bank of England rate, on, of course, the moves and the need to address that double-digit inflation. Let's cross over now to Leanne Gearens with the First Word News. Leanne.
Tom, good morning. Fox News has agreed to pay over $750 million to settle a defamation lawsuit over its coverage of the 2020 presidential elections. Dominion Voting Systems accused the US TV network of airing bogus claims that it rigged the election against Donald Trump. Fox argued its broadcasters were protected as free speech under the First Amendment. The settlement, about half of what Dominion was actually seeking, avoids a potentially embarrassing 6-week trial for Fox. India has overtaken China as the world's most populous nation. According to UN data, India's population is now more than 1.428 billion, slightly higher than China's. Asia's third largest economy is now home to nearly a fifth of humanity, greater than the entire population of Europe or the Americas. Netflix says it will start cracking down on password sharing over in the US as it looks to boost subscribers. Following a slow start to the year, the streaming giant added only 1.75 million new customers in the first quarter, missing Wall Street estimates for about 2.4 million. Netflix also announced it is shutting down its DVD delivery operation, ending its original business after a 25-year run. Global news powered by more than 2,700 journalists and analysts in over 120 countries. I'm Leanne Gearens, and this is Bloomberg. Tom.
Leanne, yeah, that's the headline for me, that they're closing down the DVD business. I didn't know they were still in it. I knew that's the way they originated, of course. But 25 years later, there they go. They had a DVD business up until about yesterday. OK, let's cross over now to what is happening in Ireland. Bloomberg hosting its inaugural New Economy Gateway Europe conference near Dublin, on the outskirts of the capital. Bloomberg's Francine Lacqua joins us live from the forum in Ireland. Francine.
Yeah, good morning, Tom. We're quite excited to be here in Dublin. This is the first Bloomberg New Economy Gateway. Now, we usually host this conference in Singapore. This time, we're deciding to focus, of course, on trade. We also have a great conversation on banking, not only what some of the Swiss banking turmoil means for European banking, but how they can still service their clients across the board. Now, very shortly, Eric Schatzker, the editor-at-large for this conference, will also speak to Andrea Orcel. He's the chief executive officer of UniCredit, one of the largest banks, not only in Italy, in Europe, but if you remember, he was also number 2 at UBS. It'll be interesting to have any thoughts that he has on the merger between UBS and Credit Suisse. And a little bit later on, we also focus on the airlines. I'm very much looking forward to hearing from Michael O'Leary, the Chief Executive Officer of Ryanair, to see not only what he thinks foreign direct investment looks like, getting into Ireland on the back of the US president showing up here last week, but then we'll also hear from Willie Walsh, who's former BA Chief Executive, Tom.
Okay, but the Ryanair CEO, he's so quiet and meek. Yeah, let's brace ourselves. It's often firing, isn't it?
Absolutely.
Fiery, of course, with the head of Ryan. That's going to be a lot of fun.
Last time.
What else? No, carry on, Fran.
Tom. Yeah, so last time we spoke to him, he said that he surprised all the passengers by being at the gate and checking them in. So I can't wait to see how he arrived, back in Ireland and who he was checking in this time. I mean, it's never dull. And I know he's doing a conversation on Brexit. He never, ever holds back from talking about Brexit or anything political. So it'll be interesting to know what he says about that.
Yeah, that is going to be a really gripping conversation, isn't it? And you've also been talking healthcare, supply chains, post-pandemic, what's happening with the vaccine makers. What else has kind of really stood out to you as we just kind of start and edge into the beginning of this event?
Well, when you look at global supply chains, and we had a good conversation with one of the vice presidents at AstraZeneca, Pam Chen, she says she's worried, certainly in her field, which is healthcare and biopharma, that as geopolitics gets more fraught, as we have a lot of domestic input to try and get some of the supply chains back home, that actually all of this globalization ruptures. Now, what this means for the production of vaccines, but also how you ship vaccines across the world, could have huge implications for her industry. Now, it was interesting also to get her thoughts on the Inflation Reduction Act. And I know we'll spend a bit of time here speaking to big chief executives of financial firms about not only the debt ceiling in the US and what that means for markets and what that could be the implication longer term, but the Inflation Reduction Act. So this is, for example, Ireland. If you look at how much foreign direct investment they've attracted, 9 billion last year, 70% of that is from US investors. Does that money go back to the US instead of coming to Europe because of the Inflation Reduction Act? Again, they're trying to do everything when it comes to help with climate change, research and development and the like. So these are just some of the good conversations that we're hoping to have here in Ireland.
Okay, excellent stuff. Lots, of course, to work through in terms of the big topics of the day. Francine Lacqua on the ground for us, of course, just outside of Dublin. We'll be crossing back to Fran just in the next couple of minutes. Let's get a pre-market check on Tesla, because guess what? As forecast, they have cut prices again, second time this year in the US. In terms of the models, we're talking the Model 3 and the Model Y. And this, again, a reminder that this is a company that is prepared to sacrifice its margins on the altar of market share. Pre-market, Tesla down 1.6%. So just as an example, on the Model Y, again, this is stateside, you're looking at a drop in terms of prices of 5.6% to just below 50,000 US dollars. Again, the margin's going to be squeezed and hit on the back of this, but it's about maintaining and expanding market share. And this is driving a lot of pressure across the auto space, others having to respond with their own price cuts. We'll keep across this story for you, of course, currently down 1.6% pre-market. Let's check back in on Netflix as well. Originally and initially, after the results came out, you saw a drop of about 12%. And then you had the commentary from the executives where they really laid out a scenario where things will improve. The expectation, of course, for Netflix as they crack down on password sharing. They think there's about 100 million people who do not pay for access to the service as they crack down across the various different jurisdictions. They think they're going to get those subs back up. And then you saw that big pairing of the drop. You're currently down about 1.1% on Netflix. But again, the context is you saw a sharp drop of 12% straight after the results. A little bit of comfort coming through in terms of the forward guidance then on Netflix. Just checking in on two of the big corporate stories. Morgan Stanley, of course, on the banking front is up later today. Really interesting, particularly to focus in on the fixed income part of that business after the disappointment of Goldman Sachs. Meanwhile, on Netflix, reporting, as I said, lower than expected subscriber gains for the first quarter. The streaming giant says it is expecting growth in the second half of the year, again, as it cracks down on password sharing. Some tech analysts, they say the company should stop focusing on sub numbers. Take a listen.
But if we start to see them continuing to grow on a revenue basis, and again, advertising becomes an important revenue. As soon as you add advertising in the mix, I think you have to drop just subscriptions because it's going to change the overall picture from a revenue perspective for them. So yeah, I mean, people are still going to look at it for the next couple of quarters, I think. But over time, I say by this time next year, for sure, it's going to be a revenue only story.
I think I'd be more interested in profitability and the fact that we're in a year where we're comparing against still some COVID impact in different parts of the world. I would say that we need to stop focusing on the subscription growth and really focus on, as I said, free cash flow growth.
All right, some commentary there on those Netflix earnings. Let's listen in now and cross back to what's happening in Dublin. Discussions at the new Economy Gateway, just outside the Irish capital. Bloomberg's Eric Schatzker is speaking to UniCredit Group CEO Andrea Orcel at the forum. In a moment, we will be crossing over. You can see Eric Schatzker there on stage. Important in terms of the conversations coming up around the banking space, of course, in Europe. We're going to be speaking and hearing from the CEO of the Italian lender UniCredit. In terms of the banking stress, credit conditions, of course, the loan requirements, and to what extent asset quality is holding up in this environment. It's worth checking in on the markets at this point, because to point out that European stocks are down 0.4% is really missing the story of the moment, which is repricing in UK assets on the back of double-digit inflation. And you can tie the inflation story, of course, to what's happening in the banking space. But briefly, let's check in on gilts then. You're looking at a move significantly high in terms of yields at the front end, 12 basis points at the front end, the 2-year, 381, at the back end, 382. So look at that bear flattening then. 2-year at 381, 10-year at 382. The pound, we'll have a look there as well. There was a pop versus the euro, versus the US dollar. Again, double-digit inflation remains the story in the UK. It's not the story in the US. It's not the story in the Eurozone. It is the story here, though. There are political consequences of this, and there is, of course, the response from the Bank of England as markets now price in rate hikes, not just in May, but also in June. A reminder that the rate here from the Bank of England is currently at 4.25. Markets now expecting you're going to get to 5%. How much damage does that bring to bear on the UK economy? And what does it mean politically as well for the government of Rishi Sunak? There's the pound then, 124, gaining 0.2%. NatWest, HSBC, they have a target, 130. We're moving in that direction. Let's cross back to Francine Lacqua on the grounds, just outside of Dublin, ahead of this panel. Francine.
Yeah, Tom, I'm looking forward actually to hearing Eric Schatzker in conversation with Andrea Orcel. This will be the first time that we hear from Andrea Orcel since the banking crisis, actually in a public forum. So I think some of the things that Eric will try and get out of him is, first of all, how he lived through the month of March. So you're a global chief executive, but based in Italy, which means that you're much closer to the banking crisis in Switzerland. So what did it feel like when SVB went down that Friday night? Was he really trying to follow what was happening in the US in terms of deposit guarantees, because that has a huge read across for the European banks? It'll be really interesting to also see whether the fact that now Switzerland has only one major bank, with essentially cutting off some of the other investment banks, whether it still means that Europe, and I know this was previously, certainly when he was at UBS, one of his big dreams, that Europe would have an investment bank strong enough to rival some of the Wall Street titans. So if you look at the context, you have JPMorgan, really some pretty incredible results. You have the same for Bank of America, Morgan Stanley doing really well. With the consolidation now of Credit Suisse and UBS, where does it leave European banking? Do we need a national champion regional nations champion to try and service some of the clients so that it takes a bit of market share from the US. So I think they'll focus on that. And then just in general, where he sees interest rates and what that means for his business model and deposits. We saw, and Tom, we were talking about this on air yesterday, the fact that Apple with Goldman Sachs has this new deal where actually you get 4.15% on your deposits. How does that change all of the European banks?
Really, really interesting point. Let's listen in now to those discussions and hear from the CEO, of course, of UniCredit, Eric Schatzker, speaking to UniCredit Group's CEO, Andrea Orcel. Let's see if he put some of those questions that Fran flagged to the chief executive. Let's listen in to the forum, Bloomberg New Economy Forum, just outside of Dublin.
Andrea, it is awfully good to see you here.
Thank you, Eric. Very nice to be here.
I'm going to remind you that just 6 weeks ago, it seemed like the world was barreling headlong into another banking crisis. There was a real sense of panic. There was a historic flight to safety in the Treasury market. I want to know, what was it like running a bank and worrying if this wasn't 2008 all over again?
Well, I think that obviously when you see shocks like this one, and not one, but more than one, at the same time, you question whether you're missing anything. And then you review everything that you're doing and you're saying, well, can it happen to me and what's different? I think that the conclusion is that these were isolated cases. They were pretty much idiosyncratic. They highlighted that regulation, in my opinion, needs to be applied consistently across not only banks of various sizes, but also all financial intermediaries. And that you do not need to stop at rules, but also look at the principles that are backing those rules and seeing whether institutions are managed in the way they should be managed. That is the key question at the end of the day. Today, we risk to have a knee-jerk reaction and add more rules, more tightening, when the banks, especially the Europeans, who have been submitted to those rules, actually do not have those problems because those rules have worked.
Silicon Valley Bank failed on a Thursday night. Within a couple of days, Credit Suisse had been forced into a shotgun marriage with UBS. How long after that, and of course Signature Bank also failed that Sunday night back in New York, how long did it take before you felt like everything's going to be okay?
Well, I think there is a general question that any times you dent trust and confidence into the system, then you worry. Because at the end of the day, banks are built on the trust and confidence. So that for me was the key issue. Is the broader market not understanding exactly what triggered the situation going to say we have another 2008 and therefore all the banks have the same issues? And the market reaction was exactly in that direction. But when you look at the issues that triggered that, at least for example in the US, liquidity, interest rate, mismatches, and we just could not be doing that even if we wanted to, and we do not want in Europe. So it does not apply. What applies is a read across that affects confidence. So let's say that we were convinced that we were in a solid position quite quickly. What we were worried about is the contagion by the lack of trust, of confidence. I think that the ECB just keeping its direction with rate increases.
Not blinking.
Authorizing us to distribute 3.35 billion of share buyback to our shareholders. That's about 10% of our market cap. Kind of underscored with facts that the situations are very different.
Today, with a couple of notable exceptions in the US, it almost feels like nothing happened last month. Is the storm really over, or might there be more to come?
Well, I do think it's more a question of, and we discussed it recently, notwithstanding what we think about globalization or deglobalization or reglobalization, I think we are substantially changing the rules that have held for all of our economies and our politics for the last 50 years. And you're having a redefinition of value chain, a redefinition of political weights, a redefinition of friends and foes, interest rates that for Europe have not been positive for 15 years and now are positive, energy prices that are changing, structural inflation in the system. It's just not credible that we're not going to have uncertainty, and shock. So I think what has changed is you manage for a central scenario, and at the moment we all feel, okay, we're back to the central scenario, but you need to anticipate that you're going to get deviated by one issue or another, and as long as you are prepared for that and you react quickly, hopefully you're going to be okay.
Bank regulators in the United States and in Switzerland swooped in with backstop funding to keep the crisis contained. It happened with the Swiss government, Swiss National Bank. It happened with the Fed and the FDIC. We've learned over the past 15 years that government action has unintended consequences. Should we be worried about the unintended consequences of this government action?
Well, I think that when you have a bank of size and confidence goes away, the first thing to go is liquidity. Actually, we all focus on capital, but what gets a bank to go is liquidity. It's people wanting their cash back now. And so for a government to backstop that and saying that's not going to be an issue is the right thing to do. Can there be consequences? Well, it depends. I think you do that, you backstop, but the moment confidence and trust comes back, you need to pull back, because otherwise you support all the time and you create asymmetry in the market. But I do think it was what was necessary to be done. I think the more general question for all of us is not only a reminder that banks as organizations that fulfill a role have risks, and you cannot eliminate risks altogether. I read a lot of times, oh, we need to eliminate all the risk of a bank. You cannot. If you eliminate all the risk for a bank, banks do not fulfill the role that they should be fulfilling, and you're transferring those risks somewhere else. And I do think that what we need to ask ourselves is, and especially in Europe, what do we want the banking system to do? And then, based on that, what rules and regulations and what guidance do we need to do to run the banks? And I don't think we do enough of that. We do a lot more of what additional rules do I need to do to eliminate the risk, rather than if a bank needs to do X, Y, Z to support the economy, etc., what are the necessary rules and regulation to support that role, but to make it done, to ensure it is done in the right way.
Since you've mentioned more than once the importance of trust and the risks of losing liquidity in the system, I want to ask you this. It appears that one of the obvious lessons of the failure, in particular, of Silicon Valley Bank, is that today, in our digitized world, deposits can vanish instantaneously. Nobody needs to stand in line, right, to withdraw cash. All it takes is a few clicks on your smartphone. As a bank CEO, do you have to think differently about deposits now?
Well, I think we have been thinking differently about deposit and funding for a while. But what I think happens, and especially in Europe, is that the structure of the market is different. When you have this situation, people are reminded that banks are not all the same, that they're strong bank and less strong bank. And therefore you have a flow of deposit, a flow of liquidity towards the quality of the stronger banks, away from the weaker banks. Until you have those shocks, people just pursue convenience and they pursue pricing. Mm-hmm. The moment you have a shock, you say, well, hang on a second. What I want is preserve capital and have a certainty I'm going to see it back. And therefore, there is a flight to quality, and we're seeing it every day. And then it depends with the development of your client base. So depending on where we are between Bulgaria, Romania, Italy, Germany, behaviors of clients and of families and of corporates, very different. Some people are still very much attached to branch, to local relationships, and deposits are seen in a very different way to other people who probably are a lot more digitalized. If I look at the use of digital channels in Lombardia in Italy, and I compare it to other regions of Italy, in Lombardia we have 6% of branches and 11% of deposits. I do that same thing in Sicily, and I have a completely different ratio. So I do think it's not one size fits all, and among our market, we just need to follow the consumer or the client and serve them the way they want to be served.
So you're right, of course, that there is a movement of deposits from people, from institutions people perceive to be weaker to institutions that people perceive to be stronger. It's happening here. It's also happening in the United States. That has consequences, doesn't it? I mean, if you lose your funding base and you cannot adjust your assets quickly enough, you've got a problem.
Well, you do, but
and then regulators are going to have a problem.
You do, but in practice, there is always a question of what is your structure of your asset and liabilities? What is your interest rate risk? For example, at UniCredit,
I'm not saying you have a problem.
No, but what I'm saying, at UniCredit, first of all, there are limitations on the BAL on what we can do with interest rate risk. And secondly, at UniCredit, we swap everything. Everything is floating. So
in other words, what SVB did not do.
Mismatch. I don't run this mismatch. So that is penalizing in period of low interest rates because I don't get the benefit on my interest margin of that mismatch. But by being conservative, when you have a shock like that, I don't feel it. I don't have the same element of issues. That's why I'm saying rules, but also what is the spirit of regulation? Is the bank run in a way that if you get shocked, you can absorb the risk that you're taking? And I think we need to step back sometimes because the mere application of rules is not enough.
Andrea, my editor-in-chief, John Micklethwaite, has argued that the latest round of bank bailouts signals a new era of what the French will call dirigisme, the state control of finance. And if Europe wants a real banking union, it has to consider cross-border mergers to create continental champions. Is he right?
I think we talk a lot about banking union, we talk a lot about capital market union, and we talk a lot about cross-border M&A. I think the bigger question is...
None of those three has happened.
Well, because the bigger question is, and you were saying something about that in your opening remark, is what does the European Union want to be? What does Europe want to be? Because either we want to pursue that convergence that we started with the project. We have a clear ambition to delegate some of our sovereignty of each state to the center and create an economic bloc that can be as strong as the US and China. And I do think that globally, there will be a benefit for having a third economic bloc that can stand. And at the same time, for the Western world, it's a very good thing to have. Or we're going to continue to say that we're all different and to say that we have a European Union, but with so many exceptions and so many limitations, that then when you ask me, banking union, I'm sorry, if we're all fragmented, union of what? Capital market union. If we're fragmented, capital market union of what? Cross-border M&A. If I don't have free flowing of capital, liquidity, clients, because I don't have a real united market, what are the synergies and the benefit to do a cross-border acquisition? So I do think that the key question is, do we want to, post-Brexit, post this shock, review what Europe should be and converge to that? Then the banking union and all the objections that we have will go away because we are converging to that. Or we want to remain as we are, saying we are a federation, but not being one, and then say, oh, but I want the banking union as well. It's never going to work.
So just let's get this straight. You are asking what to me sounds like a rhetorical question. If Europe really wants to be on equal footing with the US or the North American market and China and its sphere of influence. It can't just be a monetary union. It has to be a fiscal union. It has to be a banking union,
well,
a capital markets union.
It definitely has to go a lot further. I think if you look at European population, education, innovation, GDP, potential, it has all the ingredients to be on par or in the middle with those economic blocs. We never are. In a way, and in a very small way, it's a macrocosm of what UniCredit is. 13 bank, 13 market, large fragmentation, large complexity. You either bring it to common denominator, or all you have is fragmentation and complexity.
So what role does UniCredit play? Do you become a consolidator in this unified market that you dream of?
My predecessor believed in a united Europe and built UniCredit. With the benefit of hindsight, if you asked any research analyst, they would tell you it doesn't work because it's complex and fragmented. So in our mission statement, we want to be the bank for Europe because we are highly dependent on Europe. We want to see a winning Europe because that would create an immense opportunity for UniCredit. But UniCredit cannot become a pan-European bank if the European Union is fragmented. It will not, and no other bank can do that.
So in other words, are you telling me that you're not going to go out and buy anything in any of the countries in which you currently have a footprint, in Germany, in Italy, or any of the other countries in Europe in which you don't have a footprint until there is movement toward this banking union?
What I'm saying is that at the moment, the incentives to do M&A are limited to countries where you're local. We're local in 13 countries. Other banks are local in 2 or 3. Other banks are local in 1. Once you cross the border, if you do not have a unified market and free-flowing capital, free-flowing liquidity, and common rules, your synergies plummet. And therefore, there is very limited incentive to pursue that.
Andrea, people here have a few questions about the economy, as they should. Bank balance sheets are supposed to be one of the chief transmission mechanisms for monetary policy. Here in Europe, as you've alluded, the ECB is still trying mightily to slow inflation. Are you tightening access to credit?
Well, I think that you go back to what is the broader picture. You go back to what should bank be doing. So if banks are a transmission mechanism, and they are, and if capital markets are underdeveloped in Europe, as they are, whatever monetary policy you want to have or economic policy, you need to use the banks. So if you provide more liquidity but restrict the banks from multiplying it, then you're working against yourself. And at the moment, regulation and objectives are not.
They're not aligned.
They're not aligned. So because the regulation is to make banks strong, not take risk, etc. But when you have a recession, what are you doing? When you have COVID, what are you doing? You're flexing. And so if you flex and it restricts on the other side, you have two opposing objectives. As far as we're concerned, we are very well capitalized, we're very liquid, and we see this disruption, or this uncertainty more than disruption, as an opportunity to bring to bear our strengths. So we're not restricting. We're disciplined. We know where we want to expand, where we don't want to expand. We look very closely at risks. But at the moment, our stance is one of steady as she goes and probably trying to gain share, not lose it.
And what about credit quality? What about the quality of your loan book?
Well, this is one that is a very interesting question because I think everybody in the room will look at what's happening with inflation, what's happening with energy prices, what's happening with let's say the P&L of corporation or the budgets of families below a certain level, and you would say your credit quality is going to go really bad. But we started saying that since the invasion of Ukraine, and every quarter the banking system has registered record low cost of risk. So it does seem that the transmission is not happening. My views is that the economy is very different from what it was before, in as much as government intervene in certain sector, intervene in certain segment of population, with subsidies and with incentive, and it's fragmenting the way the economy is reacting. That said, our base case is that the cost of risk that we have this year will remain at the same level as we had it last year. That's the scenario that we have. We have, as of April, no indication of a worsening of our cost of risk, not in corporate, not in retail. And however, because we're not sure we're right, we have 1.8 billion of overlays in case things go the wrong way. So it's almost like we're managing for the central scenario, and we're looking at what we see, but our mind is telling us that maybe we're missing the iceberg, and if we are, we have something to protect us.
Andrea, you told us earlier that the future you see is one of uncertainty, uncertainty, uncertainty. What kinds of crises should we be preparing for?
Well, I think one of the key things that I probably learned in my days of investment banking is that the next crisis is never the same as the prior one, because everybody is very focused. Now we're all focused on liquidity.
That's in the rearview mirror.
Okay, how much have we been focused about liquidity in the last 10 years?
Not.
Interest rate risk, how much have we been focused on interest rate risk in the last 10 years? Okay, so now it's shocked. Now we're very well aware. And now the question is, what else? Is it climate change? Is it disruption of value chain? I mean, we underestimate the effort that certain companies, you take an automotive company, somebody was telling me that if you are building an internal combustion engine in Germany, your dependence from Russia used to be de minimis. On an electric car, more than 50% of value parts. So that does not mean, what does that mean? That means that we need to reallocate the entire value chain away from the provider somewhere else. And by definition, it's going to be more expensive, and the speed of obtaining the parts and what you need is going to take longer. That means that entire sectors are redefining their logistics, their providers, their cost of production, and all of that is happening in a compressed timetable where you have uncertainty in the economy, and therefore you're asking yourself, am I investing too much because the world is growing only at 1% or 2%?
Fascinating conversation there between UniCredit Group CEO Andrea Orcel speaking to Eric Schatzker at the Bloomberg New Economy Gateway Europe in Ireland. Really fascinating lines on the cost of risk, really interesting on the fallout, of course, of the banking crisis and the changes more broadly, the fundamental changes that are happening in this economy, saying that we're not concerned in terms of contagion, pretty worried about the contagion at the beginning of the crisis in terms of a lack of confidence. But now they are thinking differently, he said, about deposits and funding, and saying that in terms of M&A, and that's a big question, of course, across the European banking space, consolidation, in terms of M&A, that the incentives for cross-border M&A in Europe are pretty limited. Coming up, we are going to be sticking to Bloomberg's New Economy Gateway in Ireland. We're going to speak with IATA's Director General Willie Walsh. Really interesting conversation coming up then about travel and the pickup that we're seeing, whether it can be sustained as airlines get back onto a slightly surer footing. That is coming up. This is Bloomberg. Welcome back now. Bloomberg New Economy is hosting its inaugural event in Europe, which will bring together regional leaders to discuss the most pressing issues facing its economies. Let's cross over then to Ireland, where Francine is standing by with a guest. Francine.
Thank you so much, Tom. I'm delighted now to talk aviation. We were just talking before about healthcare with AstraZeneca. Then we heard from Andrea Orcel on banking. And now we're delighted also to be talking about aviation with the IATA Chief Executive, Willie Walsh. Thank you, Willie, for joining us. I mean, jet fuel, inflation, there's so many concerns out there. How are you expecting that to impact the aviation industry in the next 12 months?
Well, I think the positive is demand remains strong. And when we look at, high oil prices, we've seen that before in the industry. Inflation, we've seen that before. If you've been around long enough, these are business as usual challenges, and it's clearly a much better environment than it was over the past 3 years.
But then we talk about a possible recession, and we haven't really, there's a mismatch between what chief executives are expecting, what companies are expecting, preparing for the worst, and actually the real data in the economy. How are you expecting, I guess, the recession to play out and what that means for consumer demand on traveling?
Yeah, I think most talk of recession has eased a little bit. Certainly if you go back 3 months ago, I think there was a lot stronger concerns about recession. The interesting thing we are seeing, though, is employment levels remain quite high. And therefore, I think people still have confidence in spending money. So it's quite different to situations we've seen in the past, where typically these concerns about recession were also associated with higher and increasing levels of unemployment. So it's a different scenario today. And all of the CEOs I'm talking to in the industry remain cautiously optimistic about the outcome for this year.
But different scenario because you think the recession will be shallow, or also because there's still this pent-up demand because we were locked up for 3 years because of COVID?
Yeah, clearly demand remains strong. But I think there's another factor from an airline point of view, and that capacity is not coming back as fast as maybe people had expected. And some of that is because of disruption to supply chains. A lot of airlines are having difficulty getting spare parts. There's delays in the delivery of new aircraft. So we're seeing quite a good match between the increase in demand and the increase in capacity.
How worried are you about these supply chains and actually how long this will last?
Yeah, I think it is a concern, particularly in relation to the spare parts. It's pretty much every airline CEO I talk to now is expressing concern, and there doesn't appear to be any near-term fix. So this is probably something that will continue into 2024 and maybe beyond. But we would expect the manufacturers to get this issue sorted out by then.
But so that also impacts, real deliveries of new planes.
That's correct, and the existing or the older planes that were in operation that were grounded in 2019, they're not coming back into service as fast as people expected because the parts aren't there to get these aircraft back in the air.
With China reopening, what impact does that have on air travel across the world?
Yeah, that's been a positive because we didn't expect China to open in January. So if I look at international travel within Asia, last year it was at 22% of where it was in 2019. In February, we were at 57%. So we're seeing capacity and demand coming back in Asia. It's a bit slower than maybe people had expected, and I think that's because people remain a little bit cautious. And some countries still had some travel restrictions in place. So it's a positive, definitely, but I expect European airlines to be a bit more cautious about adding capacity into China than the Chinese carriers into Europe.
Can aviation do a lot more when it comes to climate change? Or actually, given also the situation with fuel because of Ukraine, that seems to have taken a little bit of a backstep?
No, I think the positive is that even through the recession, airlines continue to invest in sustainable fuel and make commitments to further future purchase of sustainable fuel. And despite the crisis, every single drop of sustainable fuel was bought by the airline industry in 2021, 2022, and again this year. So we're absolutely determined. We've made a commitment to net zero in 2050. We know what it is we have to do. What we're looking for is some government policies to support the production of sustainable fuel, because there's no issue with demand. I've heard some people say that they need to see demand signals before they'll build the capacity. The demand is there. It's real. Airlines want to buy it. We just want to see it in greater quantities.
Willie Walsh, thank you so much for joining us. That was the Chief Executive Officer of IATA. With that, Tom, I'm going to send it back to you, and then we'll have plenty more throughout the day here in Ireland.
OK, great stuff. Bloomberg's Francine Lacqua, of course, on the ground in Ireland at that event. Coming up, UK inflation coming in hotter than expected. We discuss what this means for the Bank of England. That is next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Tom McKenzie in London. Now, to one of the top stories of the day. UK inflation has come in hotter than expected, 10.1%. A reminder that the UK is now the outlier, 6.9% in the Eurozone. We're going to get refreshed data just in the next couple of minutes out of Europe. 5% in the US, 10.1% here in the UK. Let's bring in Christine Aquino, managing editor for Bloomberg Markets today. And Christine, there has been a market reaction to this data.
Absolutely, Tom. It wasn't entirely clear, though. If you're looking at the pound chart, there was a really clear spike initially after the inflation print. And then I think traders were realizing that, oh no, more BOE rate hikes, potentially bad for consumers in the long run. And so we saw a dip in the pound. Eventually, it ended back up again. So I think traders are still trying to make sense of the immediate impact. I mean, it is positive in the short term, but in the long term, they're questioning what this all means. If the BOE ends up doing more rate hikes than they expected, what is that going to mean for consumer debt, household mortgages, and things like that in the long run?
And gilts selling off. You're seeing that quite pronounced at the front end. A 13 basis point move higher in yields, 382 at the front end. Gilt 2 years. What does it mean for the BOE? Where are the markets then in terms of pricing in May, June and beyond for the Bank of England?
Well, I think they're definitely nailing on those expectations for rate hikes, definitely for May as well as June as far as the markets are concerned. And the Bank of England, I think, is going to have to follow suit just because in a combination of today's data as well as yesterday's unexpected wage increases really just drives home the point that inflation in the UK is proving particularly sticky, especially compared with the Eurozone and the US. Both of those are single digits heading in the right direction. That's really just not the case for the UK.
A different story and political costs, arguably, as well for the Prime Minister as he continues that pledge around halving inflation by the end of the year. We'll see if that indeed comes to the fore. Always excellent, of course, breaking down the market reaction to that CPI print out of the UK. Christine Aquino. We're also minutes away, as I mentioned, from the March inflation print for the euro area. That after ECB Chief Economist Philip Lane told us he is backing a rate hike at the next meeting. European markets down 0.3%. Futures in the US lower by 0.4, 0.6 on the Nasdaq futures. Bloomberg Surveillance early edition continues in the next hour with Matt Miller in New York and Anna Edwards here in London. This is Bloomberg.
I think there's going to be more volatility in inflation over coming years, and I suspect on average it'll be higher.
Inflation is going to fall back to 2%. The European economy is not going to go into recession.
If inflation targets remain as they are, and we do have central banks keep pushing to try and get inflation back down to target, well, you know, there is this risk to the economy. There is this risk that something else breaks.
This is Bloomberg Surveillance, early edition, with Anna Edwards and Matt Miller.
It's 10 a.m. in London, 5 a.m. in New York and 5 p.m. in Hong Kong. Our top stories today. Job cuts on the way at Meta and Disney. Thousands of positions are being eliminated starting today. New figures strengthened the case for the Bank of England to raise interest rates once again. Britain's inflation rate remained in double digits last month. And how does Morgan Stanley stack up against its Wall Street peers? The bank reports its earnings in 2.5 hours' time. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. The inflation story is certainly dominant here in Europe today, Matt. Over in the United States, we focus on banks and futures slip a little. Some negative sentiment perhaps from some earnings.
Yeah, well, and I feel like the UK inflation story is actually reverberating around the world because a lot of people are now expecting tighter rates or higher rates for longer. We had comments from Bullard yesterday saying he wants to go between 5.5 and 5.75. He's not a voting member, but he makes some very strong points. Let's take a look at what's going on in U.S. markets. We are now down about 0.4, almost 0.5% on S&P futures. We managed to eke out a gain in the cash trade yesterday, but the Dow and the Nasdaq both closed down. So the S&P was kind of the outlier there. We have bonds down as well, and that pushes the yield up another 4 basis points. Wow, 420. We're almost there, by the way. Right now, 361.76 is the level on the 10-year, but you see yields going up much higher on the 2-year on the shorter end of the curve, as well as investors maybe starting to price in more than one rate hike. NYMEX crude is off about 2% right now. We're down below $80 a barrel, and we've fallen below key levels on a lot of big commodities. Bitcoin is down about $1,000 under 30 right now. NYMEX under the $80 handle. Gold down under $2,000 right now. Right now it's off 1.3%. It fell a little yesterday as well. So gold is now under 2 grand, and we see just a lot of selling in these markets. Take a look at what's going on in Asia. You saw a drop there as well on the MSCI Asia Pacific Index, down 0.8%. The Hang Seng down 1.4% at the close, and it had been lower, so it was able to offset some of those losses into the end of the session. The Nikkei in Japan off, but only about 0.2%. We do see dollar weakness, not against the pound. I think the pound is still up against the greenback, but we see dollar weakness against other currencies like the euro, and a little bit of dollar strength against the yen right now. 134.86 is the amount of yen. You can almost buy 135 yen for $1. What do you see, Anna, in Europe this morning?
Yeah, the inflation story certainly dominates then, Matt. We've just got Eurozone inflation, the final reading for the month of March. So this didn't tell us anything we didn't know, in case in fact, the number came in exactly as expected. So Euro area final March reading on inflation, CPI rising by 6.9%. That was exactly what the preliminary said. So as you were on that front, but that is still a lot lower than it was. It is a lot lower than the UK inflation story right now, which is certainly dominating news flow here. And we've got earnings stories as well in the mix. So this is what we see at the moment. Negativity, broad-based but fairly modest negativity for many of these European markets. The London market sells off a little bit more than the others. Here's the euro, not much movement as a result of that inflation data. As I said, came in pretty much as was expected. We did see a boost to the pound. In fact, the pound took some time to understand exactly what it meant to see that inflation print once again come in above 10%. So double-digit inflation still a reality in the UK. It has been expected to drop down below 10% for the last 2 monthly readings, and that has not happened. So the pound spiked up on that on the BOE impulse, but then dropped and then spiked up again. So a lot of volatility there. UK 2-year yield taking no time to decide what to do, to price in with more certainty a May interest rate hike from the Bank of England. So that's the bond markets quickly deciding what this means, and also pushing out that peak rate, or increasing, sorry, that peak rate where the markets think the BOE will get to. Here are a couple of earnings stories to focus on with different dynamics, actually. Heineken, the drinks maker. Interesting that the volume numbers were light versus expectations, but because European drinkers seem to be happy to continue paying up for those drinks, the investor community seeing something positive in that, and the stock up by more than 3% as Europeans turn to drink, perhaps. ASML down by 2.5% as we have the company that supplies the companies that make the chips. There have been a lot of negative expectation at the beginning of this week around what demand out of Taiwan in particular would look like. Some of that is sticky, and despite the earnings story we got out today, the outlook for the second half of the year a little hazy, and so as a result, the stock is down.
Europeans aren't turning to drink. It's in their DNA. They're just turning it up a little, I guess. All right, I think the ASML story is fascinating. We're going to be watching that, as well as the chip news that we've gotten from other behemoths like TSMC cutting CapEx. It doesn't look good for the global economy. Neither do the job cuts that we've been seeing overnight. Disney plans to cut thousands of jobs next week. That's what Bloomberg's learned. That includes about 15% of the staff in its entertainment division. This is a company with 220,000 employees. Meanwhile, Facebook owner Meta is set to begin company-wide layoffs today. A memo seen by Bloomberg indicates that Facebook, WhatsApp, and Instagram, as well as Meta's virtual reality lab, will all be impacted. Bloomberg's Alex Webb joins us now for more. So, Alex, we've seen, that on the tech side, on the West Coast, we've seen some of these job cuts, but they're now starting to really ramp up and going into other areas like entertainment, communication services, media, streaming.
Yeah, it's very much, time of reckoning for these companies that had absolutely been classified as growth stocks for a few years. Disney, had pivoted from value to growth under pressure from activist investors. It's now retrenching. It is laying people off from its entertainment division. The push had largely been towards Disney Plus, as we've seen interest rates come up. We've seen people not spending as much time in front of their devices as they've come out of the lockdowns. That has hurt the efforts with things like Disney Plus. Meta, of course, one thing that is fascinating with their job cuts, according to sources according to a memo seen by our colleagues in Bloomberg News, they are cutting the Reality Labs division. That is their metaverse effort. That's supposed to be the future of the company. It's a division that that Meta has really ceased to talk about with quite so much volume as it was, even a year ago. So we are seeing something of a retrenchment from both these companies.
Okay, a focus on cost cutting then in terms of those tech names. What about the Netflix earnings story then overnight, Alex? The earnings and then the crackdown on password sharing.
Yeah, there were three numbers that were really important here. The first quarter subscriber growth wasn't as high as expected, 1.75 million versus the 2.4 million expected by the market. The second quarter revenue was also short of expectations. That took the stock down about 12% in after-hours trading. But then as people started to look a little more deeply at the numbers, the expectations for the second half were quite good. Free cash flow, $3.5 billion. That was above expectations, above the company's forecast of $3 billion. They've increased that forecast. Part of that is to do with cracking down on passwords. It didn't happen in the first quarter, but what they're doing is they think there are 100 million people out there sharing passwords. If they can get some of those to subscribe, then that will benefit subscriber growth.
Yeah, interesting. They've been trialling some of those strategies for that crackdown in Southern America. Thanks very much for that. Bloomberg's Alex Webb joining us with the latest tech themes. Let's pivot to the macro. And UK inflation has come in hotter than expected, with the March CPI reading rising 10.1% year on year. Economists had expected that number to drop into single digits to 9.8%. This comes after Tuesday's report showing UK wage growth accelerated unexpectedly last month, adding to inflationary pressures concerning the Bank of England. Joining us now to discuss, Christine Aquino, managing editor of Bloomberg Markets Today. Christine, very good to have you with us. So we've got this combination of faster inflation and more rate hikes. Is that what is ahead? More rate hikes from the Bank of England?
I think that's definitely the conclusion from markets, and I think we see from the pound reaction as well as the gilt losses today, most signs in markets are pointing to that expectation that the Bank of England is going to have to do more, and that's probably not something that Andrew Bailey and his colleagues really want to hear, because they were guiding markets toward expecting less, even from the start of this year, and even the most recent comments from them, despite the fact that we have double-digit inflation still persisting. But I think after today's data, as well as yesterday's wage data, most signs really are pointing to the Bank of England having to add to those rate hikes.
So are people worried about a policy mistake here from the Bank of England, as they are, in the U.S.? And how are traders expected to react?
Well, Matt, yeah, definitely thinking about the potential mistakes here. I think initially, given that the guidance for the Bank of England was for markets to expect less in the way of rate hikes, but we just kept getting persistently high inflation readings. It hasn't dipped down to single digits for a few months now. And I think that's where potentially the initial mistake was, right? That the initial guidance for less in the way of rate hikes, and now having to potentially backtrack on that given the inflation print. But I think toward the back half of this year, the potential mistake could probably come from expectations of the Bank of England having to pull back on their efforts because of the impact of rate hikes. It's a very similar dynamic to what we've seen in terms of how markets are trying to read the Fed, right? They're kind of trying to think, well, the rate hikes are going to be negative for the economy eventually, and therefore expect rate cuts. But just given the persistence of inflation in the UK, it's going to be hard to see a situation where that would be viable even in the second half of this year.
All right, Christine, thanks very much. Christine Aquino there talking to us about 10.1% inflation, beating the estimates on kind of the wrong side yet again. Let's get back here to the U.S. Legendary trader Lee Ainsley of Maverick Capital sees inflation increasing once the war in Ukraine winds down. He spoke at the Economic Club of New York yesterday in a rare appearance.
My thinking is that the baseline inflation underneath all this is actually continuing to march upwards. Decarbonization, deglobalization, people miss just the aging of our populations. The active workforce is shrinking. That's part of wage inflation. And so I do think particularly wage inflation may be a little stickier.
Shonali Basak, our global finance correspondent, joins us now in studio. So, Shonali, we heard it from Ainsley there, concerns that this inflation is going to be persistent.
Yeah, you definitely have one of the most well-known Tiger Cubs now beating that higher for longer drum, something we heard from Jamie Dimon just about a week ago. And listen, there are some very interesting implications for the hedge fund industry in particular. Some of the things he pointed out was what this would mean for the pod model. Remember, a lot of these multi-strat funds run on a lot of leverage. And so what does it mean as interest rates go up, not only for the their own models, but the competition for money. The other thing he talked about, Matt, is what it means for the crossover fund model. A lot of these hedge fund firms have gone into the private equity business, which also requires significant leverage. And, it's an interesting equation once you think about the capital calls they also need to keep making to try to meet those new investments. So remember, David Solomon yesterday over at Goldman Sachs got a question from an analyst about the worries about the hedge fund industry. His answer really was that Goldman in particular is flocking to the top 100 funds. And so you do see a washout in the industry that has already been at bay, but how the banks react to the industry and the leverage they're willing to provide them, the business they're willing to provide them, will really set the stage for the investing world in the next year or so.
And we've seen how quickly that can come unstuck in the past, haven't we? Let's get to the bank earnings story. Morgan Stanley set to report numbers. What do we expect to see here then, Shanali?
Yeah, one is on the trading side here. Again, because Morgan Stanley is one of the biggest prime brokerages on Wall Street, has historically been the largest equities trading shop on Wall Street. While we watched Goldman miss on fixed income yesterday, they beat on equities trading. So it is a soft market for equities trading, but will Morgan Stanley still hold strong in that market after last year kind of falling behind Goldman for a couple of quarters? The other thing we'll want to watch is what they have gained in terms of business in the wake of Silicon Valley Bank's troubles. Remember, Morgan Stanley would arguably want to be one of the biggest beneficiaries here, Anna, because Morgan Stanley had such a big base of high net worth clients. We have seen, there's no other way to put it, the biggest banks really benefit in the wake of this storm. Things are looking like they're starting to stabilize, as we saw from Western Alliance's own numbers yesterday. But how much has Morgan Stanley won, and how sticky will some of that business be?
All right, our top Wall Street reporter, Shanali Basak, thank you so much for joining us this morning. Now let's get a look at some of the stocks we're watching in pre-market trading here in the U.S. this morning. Keeping an eye on regional banks because Western Alliance has surged as deposits rise by $2 billion this month. You can see the stock there up 15%. In the pre-market. PacWest up 4 1/3% in sympathy. So watch those regional banks in this morning's trade. Intuitive Surgical reported worldwide procedure growth for the first quarter that beat analyst estimates. You can see the stock up 7% in the pre-market. Procedure growth worldwide, so surgeries that it's done, was 26% higher than it was at the same time last year. The estimate was only for 15% more procedures. HP and Dell are among some of the technology companies that are falling in the post-market trade. You can see HP here down 2% in the pre-market. Sorry, in the pre-market trade. They were down obviously in the post-market yesterday as well. IT products and services company CDW reported preliminary quarterly results that missed. And then Tesla, cutting the price of its highest volume models yet again in a further sign that the chief executive officer, Elon Musk, is willing to sacrifice some of the industry-beating profit margins that Tesla has in order to build even more demand. The Austin-based automaker marked down some more Model Ys and Model 3s, an average of about 5%. But I think they've cut prices now like 5 or 6 times so far this year. So a lot of consumers, Anna, are maybe waiting to make a purchase for that next price cut.
And we will get some analysis of what to expect from Tesla in the earnings story there shortly. We also got European car sales numbers showing some robustness as we say goodbye to some of those supply chain issues post-pandemic. And now, just to tell you what's coming up on the programme, we will be speaking to Thushka Maharaj, multi-asset strategist at JPMorgan Asset Management. How is she playing the current environment in markets? What does she make of the latest inflationary drivers that we're seeing here in the UK and perhaps elsewhere as well? And Kallum Pickering joins us, Berenberg senior economist, also to weigh in on the inflation story. This is Bloomberg.
Q1 suggests we are seeing a reversal of the negative supply shocks that so dominated the European economy last year. So easing of bottlenecks, much lower gas prices. So what I would say from all of that is, as of now, 2 weeks away, I think the baseline is that we should indeed increase interest rates in May.
That was the ECB chief economist, Philip Lane, speaking at the Bloomberg New Economy Gateway Europe conference in Wicklow in Ireland. Bloomberg TV and radio are broadcasting live from the conference. We've heard from a number of leaders from the private and public sectors today. Tomorrow we'll hear from Ireland's Prime Minister, Leo Varadkar, among other voices. Joining us now here on set to talk about global strategy, Thushka Maharaj, multi-asset strategist at JPMorgan Asset Management. Thushka, very good to see you. We heard Philip Lane talking about the inflation story, but I'll start with the impact of the inflation story here in the UK. How does this influence your thinking around asset allocation on UK assets, given inflation still double-digit, food inflation running at not quite 20%, but high teens?
Yeah, thanks for having me, Anna. You're right. Inflation, we've had a very timely reminder that the inflation, stubborn and persistent inflation is here to stay for longer. I'd say the UK is a particular example where you have twin shocks that you are dealing with, both the labour force participation being weak and the energy shock. And for us, that complicates the Bank of England picture. What does that mean for our views on UK assets? We are warming up to duration, so core gilt bonds. But today's data does add some volatility to that. The reason why we are looking at the gilt market as a positive market to own duration in is essentially the market is pricing in over 50 basis points of hikes from the Bank of England, and we want to diversify duration across markets. On the equity side, we actually are more positive on UK equities, but that's because of global factors rather than specific UK ones.
Right, yes, as is so often the case with UK equity conversations, it's a global story, perhaps at least at the FTSE 100 level. What about more generally then, your outlook and your positioning? You said in your notes ahead of our conversation that's pretty cautious. What does cautious look like?
Cautious means we are modestly underweight risk assets, so modestly underweight in equity markets. And the rationale for that is unlikely to see significant upside for risk markets in the current environment. As you mentioned, inflation remains a concern that keeps central banks in their tightening path. We have already had a reminder in March that policy is already tight, and we will see credit conditions tighten further, and that caps the growth outlook in the medium term. So essentially, this idea that equity markets have run a long way, the upside is capped, that keeps us cautious. But at the same time, the caution we are expressing today is actually in being long duration. We see more asymmetry on the bond outlook, better return profile there than we do in equities.
Okay, Matt.
Yeah, it's interesting, Thushka, because we have seen bond spreads tighten and the VIX drop to below 17. At the same time, I'm hearing the term credit crunch more and more often. You said we could see credit conditions tighten. How much? And could it be to a concerning level? Because it looks like relative calm in markets, both in bonds and in stocks.
Yeah, that's a valid point, Matt. And I think you're honing in on the exact question we're facing ourselves. Is this going to be a sharp, quick drawdown in growth expectations, or is it a slow burn, grind lower in the economic outlook over the next 6 to 12 months? And I'd say credit availability, loan growth, and the labor market are key in sort of answering that question. So firstly, on the credit side, we are expecting slowing of credit availability. That for us takes off maybe 2/10 or 3/10 on GDP over the next 6 to 12 months. But we're not seeing it creating this big cratering crunch in credit conditions. So we are more in the camp that this is a slower grind lower in the growth outlook, and it will take time to play out. And as you mentioned, there are two-way risks around this. We're already seeing deposit inflows, as you mentioned earlier, coming back to some of the regional banks in the US. So it's more of a slower grind, and we're looking for opportunities for where we could be cautious, but be willing to wait this out as growth slows.
Yeah, I mean, a lot of people are looking at the banking crisis in our rear-view mirror now. We're seeing Jess Menton from our equities team, as well as Cameron Kreis, our macro man columnist, saying, look, expectations of a recession were much bigger at the end of last year and at the beginning of this year than they are now. Jim Bullard, obviously you're not going to have the Fed come out and push for a recession, but he's saying, I don't see it here, especially with the labor market that we've got. are expectations of a recession now lower than they were previously, meaning risk assets have a chance to continue this run higher?
Yeah, so we have increased our recession risk post the banking stress in March, but it's not our base case. We're not in the camp that we are like, that recession's nailed on and that we need to be extremely cautious. What's keeping us cautious is that even in our relatively positive view of the economy, we think risk markets have already run a long way. And in the positive scenario, central banks are still hiking. So they are raising the cost of financing as growth improves, and that caps the upside for risk markets. But what you highlight is a valid point. Where can we look for that asymmetry? And credit or high quality components of credit are starting to look attractive in our base case scenario. Recession risk for us, I'd say, is a bit, is between a 25 and 30% likelihood over the next 12 months in the US. But look outside the US, growth in Europe, China, we are seeing a much better outlook there. So it's very differentiated across the globe.
All right, Thushka, great to have you on the program. Really appreciate your insight. Thushka Maharaj of JPMorgan Asset Management talking to us about really the importance of active. You've got to pick your spots for that opportunity. Now, keeping you up to date with news around the world, here's your first word. Senior Russian officials have raised concerns that the war in Ukraine has left Moscow too reliant on Chinese technology after the U.S. and EU sanctions shut off access to alternative suppliers. An internal Russian memo suggests Moscow is cornered and concerned that Chinese technology reliance may pose a risk to Russia's information security. Fox News has avoided a potentially embarrassing trial. The network agreed to settle with Dominion. They'll pay $787.5 million to settle that voting machine maker's defamation lawsuit over its 2020 election broadcasts. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Job cuts on the way at Meta and Disney. Thousands of positions are being eliminated starting from today. New figures strengthen the case for the Bank of England to raise interest rates again. Britain's inflation rate remained in double digits last month. And how does Morgan Stanley stack up against its Wall Street peers? The bank reports its earnings in 2 hours' time. I'm Anna Edwards in London with Matt Miller in New York. And sentiment deteriorating the closer we get to the start of US trade, it would seem. The inflation story out of the UK certainly catching our attention from the macro standpoint, but a lot of corporate earnings to focus on as well.
Yeah, I think we had Goldman Sachs and Johnson & Johnson yesterday dragging on the indexes, and now you've got this big inflation number out of the UK, I think igniting a little bit more concern around the world that that inflation could be higher for longer and rates may have to go higher with them. We heard from Bostic, we heard from Bullard, and we'll talk about that in just a little bit. S&P futures are down about 0.5%, a little bit more now than 0.5%, and you're seeing a lot of selling in this market no matter where you look. For example, investors are selling off the 10-year note, and so the yield rises another 4 basis points right now, 361.57. Selling off NYMEX crude, we were at an 80 handle or above, really. I mean, we'd gone up to $80 a barrel post OPEC plus surprise cut. Now we're coming back down below $80, and even Brent is looking pretty weak. Gold had been up above 2,000. We were on all-time record watch to see if it could eclipse 2,075. It's now back down below that, not terribly significant, but big round number of $2,000 a troy ounce. And even Bitcoin, for example, is down about $1,000 below 30,000 right now. So investors are really taking some chips off the table. take a look at some of the movers here in terms of individual stock stories. You have some good news. Western Alliance rising after the bank beat earnings estimates and said deposits recovered. You can see Western Alliance is up, and then other regional banks are gaining in sympathy, but 15% is better than a stick in the eye. Intuitive Surgical, also a big gainer, 7% this morning, saying that worldwide procedure growth for the first quarter beat the average analyst estimate. They did about 26% more procedures than they did in the same quarter last year, and the estimate was only for 15%. Netflix, on the other hand, is down 1.5%. We talked to Alex Webb about this just about 15 minutes ago. Netflix is down as investors are weighing customer additions and the firm's outlook. First quarter new subscribers came in at 1.75 million, and that missed some forecasts. It beat some. Netflix will start to crack down more on password sharing in the U.S. this quarter and predicts that that will boost growth in the second half. Because people who have been thus far, I guess, stealing Netflix are going to have to actually pay for it. And then Tesla cutting its prices again on some Model Ys and Model 3s. These are the more affordable models that Tesla has in the lineup. And another sign that Elon Musk is willing to sacrifice some of his industry-beating profit margins. They have profit margins that big automakers would do a heck of a lot for, like 14, 15% rather than 7 or 8%. So they can afford to sacrifice that to get more sales. But the question is, if they continue to cut prices, Anna, do you go out and buy a Tesla, or do you wait for the next price cut that you expect? That's the problem with deflation, right?
Yeah, absolutely. And there's a lot of thinking around how customers behave with expectations around inflation very much in their minds at the moment, because we talk about it all the time. Let's get to the European equity market picture then. Stocks Europe 600 down by 0.4%. And inflation is one of those themes that we're very much focused on today then, Matt. In the European context broadly, we had Eurozone inflation data confirmed at 6.9%. Higher, of course, than the ECB wants to see it. And we heard from Philip Lane in that exclusive conversation with him at the ECB, saying that he thinks we need to see another interest rate hike. And the expectation in the market is we see a lot more hikes, really, from the ECB, certainly versus the Fed. The euro, though, not moved by that particularly, 109.32. It was an inline inflation number. The two-year yield, though, certainly moved by what we've heard here in the UK. A 12 basis point move on two-year yields. Increasingly expecting in the markets that we will get another hike from the Bank of England then in the month of May. The expectation around that seems to have firmed up because that inflation print came in the UK at 10.1%, above 10% essentially, and not dropping down into single digits as had been the expectation. So really sticky there. Food prices. We haven't seen food prices like this, Matt, since you and I were very small, put it that way. Food price growth like this, I should say. ASML is down by 2.7% on the earnings story. Just covering off that one here in Europe. It's not about the backward-looking sales. They were okay. It's about the forward orders, and that seems to be weighing on the stock today.
I remember when I was a kid, I could buy a candy bar for like a quarter. It'd be great to see food prices like that again. But yeah, I get what you mean. This kind of inflation is just shocking. And I think that the UK numbers are concerning even here in the US as well. Joining us now is Kallum Pickering, Berenberg senior economist, to talk about this, the second time in a row that we've had expectations for UK inflation to fall below 10%, and yet it holds fast. What's going on, and is that kind of stickiness in prices going to be felt in Europe and in the US as well, Kallum?
Well, I think we just need to be a little bit careful putting too much weight on upside surprises when we have fundamentals pointing towards disinflation. And so, of course, we have to be cautious. The Bank of England will be, relative to its February estimate, surprised by what Q1 inflation has done. No question. And therefore, that supports the hike again in May. But the balance of demand and supply is pointing towards disinflation over the course of this year. You have big energy base effects to wash out. Monetary policy is that by now tight. Fiscal policy is buy now tight. Producer prices have turned down a lot, and actually money supply data, which had been the key leading indicator for the inflation even before the war, has normalized. And so I think we should just be a little bit careful. It's very hard on a monthly basis to calculate this stuff, and therefore if the market's off by 0.2, 0.3, it's often not a big deal in hindsight, and we have had downside surprises before these upside surprises. So I think it argues for caution, let's go again in May, but it doesn't argue for worrying about persistent or sticky inflation just yet.
Kallum, to ask a question that probably seems completely inappropriate today, because today is about firming up expectations for a May rate hike.
Yep.
When do we get to cuts from the Bank of England? If we continue to see food price inflation moving at the pace that it is, and we do see cracks in the labour market, even if the wages story is much stronger, when do we get to the cuts part of the UK conversation?
Best bet would be in Q4. We can see some cuts from the Bank of England, but the Bank of England will be, even as it cuts interest rates, arguing that we're not going to cut aggressively. We're just going to go steadily. It's a normalization of interest rates towards longer run equilibrium levels, which we think are around 3%. So our bet is 50 basis points in cuts in Q4, probably 100 basis points over the course of next year, and then the Bank of England holds. The key point in all of this is that we've raised interest rates a lot, and every time I fly over Europe, I check out the window and I say, are the mountains still standing? The answer is yes. 2017, the whole world was worried about the Fed raising by 25 basis points. What's going to happen? Now we can raise interest rates to 4 and 5%. We see that actually fundamentals are still good. And it's not just inflation and wages which surprise to the upside, it's output. The whole market, including goods, has revised our forecasts up since October because data have come in better than expected.
Now, it's easy to see how, in a sentiment sense, and on a fairly quiet day, frankly, this story goes a bit global and people start to ask questions about sticky inflation globally. But there are some very specific UK factors at work here, I assume. I mean, European inflation has dropped right down. There's a lot of divergence within the Eurozone, but 6.9% is the total number, and US inflation has dropped a lot further. So there are limits to how much this tells us about outside the UK.
It's all still too high.
Yes, it is still too high. I agree with you. And I recall over the last few weeks heading into the supermarket and not being able to get basics such as salads and other food stuff. There were some weird idiosyncratic issues in the UK linked to food shortages. So that could be playing a part here. But again, on a monthly basis, lots of things can move CPI indexes. In the longer run and in the medium term, it's fundamentals. We know that over the next 18 months, the fundamentals are disinflationary. I think if you go even further out, it then starts to turn a bit more inflationary. We start to think about deglobalization, aging populations, fiscal policy is still expansionary, especially in the US. Households are willing to spend some of these buffers that they've built up during the pandemic. And so we still have to be cautious around the inflation outlook. But I think we have to worry much less about where inflation is, say, a year from now, but worry a lot more about where it is, say, 4 or 5 years from now.
Is Brexit still a problem for the UK economy that that Europe and the US don't have to deal with? Is it still substantial?
It's a long-run friction. We've raised costs of trade with the EU significantly, but it's not the explanation for the upside surprises that we have now. I would not be surprised, actually, if the UK suffers more disinflation, say, next year than the US and the Eurozone, partly as a bit of a compensation for what we see now, but actually because fiscal policy is tight in the UK, whereas it's not in the Eurozone or in the US. I would just make a bigger point here, which is to say, inflation is a bit of a sideshow. Just look how the world has changed. Central banks are raising interest rates. Economies are still surprising to the upside in terms of economic activity. But more than that, central banks are willing to give us recessions in order to normalize inflation. This is in complete contrast to the way the world looked after the financial crisis. My view is now the world looks a lot like it did, say, in the 1990s. It's normal business cycle dynamics. It's normal reaction functions by central banks. And these upside surprises in wages and inflation and in economic data more broadly are part of the fact that the world is just in a better place. Economies are stronger.
Speaking of sideshows, can we get a 2-box? Anthony, can we look at this?
I was going to say, you look fantastic, Mal.
You look amazing. I love your style, Kallum Pickering. Thank you so much for joining us.
Thank you so much.
I'm glad you're both enjoying that so much. Yes, you both look fabulous. I appreciate the style that you both bring. Right, coming up on the programme, Tesla is cutting prices again ahead of earnings today. Matt's mentioned this a couple of times. We'll get a preview of the results. They're due out later today. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an interview with the Ryanair CEO, Michael O'Leary. That's at 6:30 a.m. New York time. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller in New York with Anna Edwards in London. Now, Tesla is cutting prices once again. That's the second time this month as CEO Elon Musk seeks to boost sales ahead of earnings being released today. Joining us now for more is Bloomberg Global Autos editor Craig Trudell. And Craig, you know, I find this story so fascinating because on the one hand, Tesla has such significant margins. It's the envy of the rest of the industry in terms of the profit that it makes on each car sold. So it's doing very well. On the other hand, it faces such incredible competition. The biggest car makers in the world are after Tesla's lunch. So what do you make of these continued price cuts?
I think it's incredible because what you're talking about does speak to, there's a sort of debate raging among the analyst community, among investors of, is this a sign that this company is in trouble or that, you know, Musk is a sort of mad genius who's going to sort of, take out the established car makers. And you have people who have strong feelings on either case, making either case. I think it's really incredible to see the frequency with which they're cutting prices this year. This is at least the sixth major set of reductions that they've done. And I think at this point, you do have to wonder to what extent are these cuts not having the sort of desired effect of a boost in demand on the basis of, if you're a consumer, why would you buy right now if Musk keeps cutting and cutting? Why wouldn't you just wait for a better deal, which is something that we're absolutely watching. And hopefully an analyst will ask Musk about this.
Yeah, that's the big problem with deflation, right? Consumers will just wait until the next price cut and the next and the next and never buy anything.
Exactly.
You know, it's funny that they only grew, 38% in terms of their top line. Speaking of the envy of automakers, like everybody wants that kind of growth. But since we didn't get to 50%, people think that Musk needs to tweak demand. What about GM? What about Volkswagen? These behemoths that are about to unleash just a barrage of competition. How much are they losing on the same kind of EVs that Tesla makes so much money on?
Yeah, so we're at least getting a little bit better sense of that from Ford, right? That just recently adopted a sort of change in the way they're going to report earnings going forward, where they're going to break things down by the sort of old combustion business and the electric business. And you know, the outlook for this year being that they expect to lose $3 billion on the EV side. I think there's probably a good chance that Ford was lowballing there. They're pretty, sage about sort of setting a lower bar for themselves that they can, cross. But it is the case that, Tesla has a huge advantage in terms of the scale at which it's making EVs, and particularly the scale at which it's making the Model 3 and the Y. These two vehicles are doing so much more volume than any other EV in the industry. And so that's the real sort of play here that Musk is making this case of, we can bring costs down, we can afford to take prices down because we're the only ones who are making electric vehicles at this, sort of level of scale.
And Craig, talking about the other companies, the other players in the industry, we got car registrations for Europe this morning, and nearly it showed that the car sales numbers rising nearly the most in 2 years. They've been held back by supply chain issues of late. Now that's going away, but concerns now around supply replaced by concerns around demand. How is that shaping up?
I think what we've been seeing the last few months is there's a lot of pent-up demand here in Europe of people who have put in orders and have been waiting months. In some cases,
the lead time's just so long.
Yeah, in some cases more than a year, right? And so what we're seeing is a sort of reflection of what demand has been. And the big question that a lot of executives are going to have a hard time sort of getting their arms around is what the sort of forward outlook is. I think, speaking of this sort of bull-bear debate for Tesla, at the beginning of this week, we've saw analysts covering the European car sector, one talking about an upcycle for Europe and another downgrading their outlook for European car makers. So, there's a lot of uncertainty here. I think, the amount of inflation we're seeing, the rise in interest rates are going to, catch up in all likelihood at some point. The question is when.
Just not seeing it yet. Craig, thank you very much. Bloomberg's Craig Trudell talking about, the Tesla numbers due out later on today and other car themes. Now, Elon Musk has said the car is one of the least efficient places to put solar energy. As we approach Earth Day, we're taking a look at the solar car of the future.
Are solar cars the next EV evolution? Decades of work on a solar car moonshot is slowing, ceding to a more pragmatic approach. Smaller, lighter, cheaper systems built to subtly augment electric driving rather than power a road trip in full. The sun is hard to ignore as it never stops showing up. And with the market now rife with electric vehicles, there is an auto ecosystem increasingly wired for electrons, including a charging infrastructure that on car solar systems would no longer have to do all the heavy lifting. As far as cost, solar panels have steadily become both cheaper and more efficient. Over the past decade, the price of solar modules per watt of power produced plunged by 78% to roughly 24 cents per watt, according to Bloomberg NEF. At that rate, a panel array the size of a sedan has dropped from $222 to just under $50. Currently, Toyota sells a solar roof as an option on its Prius hybrid. At Hyundai, meanwhile, a solar roof option is available for its Sonata sedan, and the company is drawing up plans to add solar panels to the Ioniq 5, its breakout EV. And what about Tesla? Elon Musk has stated he believes the car is one of the least efficient places to put solar. That said, Tesla is pursuing an option for its Cybertruck owners to add solar, integrated into the cover of the pickup bed and possibly as unfolding wings.
All right, I would say the key word there is moonshot. It doesn't seem likely that solar is going to be powering our cars, with direct panels anytime in the near future. On the other hand, 15 miles is nothing to sneeze at. So if that's true,
yeah,
I get why you'd put them on.
Plenty of people put solar panels on houses and they don't power the whole house, but they just kind of take the edge off the costs, don't they? Maybe there's something similar might happen in parts of the vehicle space. Right, coming up on the programme, we'll run you through the major events that we're looking ahead to for the rest of the day, including the bank earnings story. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller in New York. Now let's take a look at some of the things that lie ahead for us today. Earnings season continues, of course, at 7:30 a.m. Eastern Time. It'll be Morgan Stanley's turn to report numbers. The focus on equities rather than fixed income, perhaps, in that narrative. L'Oreal set to release first quarter sales growth after the European close. At 2 p.m., the Fed releases its Beige Book. Really interesting, even to those, it seems, who maybe don't pay attention to the Beige Book very often. It's with beige. Lending conditions front and centre, maybe it'll be less beige. Tesla reports earnings after the US market close. We just discussed what was in focus there with our colleague Craig Trudell. And Matt, we need to focus on FX markets. We've seen a bit of a turnaround in the dollar and interesting lines coming out of the BOJ, we've seen some weakness in the Japanese currency. The BOJ is said to be wary of tweaking its yield curve control policy in April. This is a red headline coming from our reporters over in Tokyo, according to people familiar with the matter. So the BOJ said to be wary of tweaking yield curve control because of the banking crisis, it seems.
Yeah, you can imagine that would cause some traders to turn around carry trades. On the other hand, I can imagine you'd be wary of such a serious policy move. So that makes perfect sense. Nonetheless, we've seen the dollar really gain ground, not only against the yen, but also against the pound. Remember, the dollar was weaker against the pound just about a half hour ago, 50 minutes ago. And now it looks like the Bloomberg Dollar Index continues to rise. Yesterday at this time, we were at 1223 on the Bloomberg Dollar Index. Now we're right up against 1229, so some pretty decent gains in 24 hours.
Yeah. Yeah, interesting to think about where we are on the BOJ conversation. I keep reminding myself, though, that as we heard from Governor UATA some time back, there is always an element of surprise, which he seems fully aware of when it comes to central bank policy. So we'll obviously follow that BOJ story as it evolves. On the dollar, then, here we have euro dollar for you. The pound, as Matt says, the pound back down to 0.1%. It got up as high as 124.7 a little earlier on. So we did see some fairly solid gains for the pound on that strong inflation print, stronger than 10%, double digits, still the reality for inflation in the UK. That is it for the early edition. Surveillance is ahead. Tom, John and Lisa will take you through all the latest market moves. They will also continue our coverage from Ireland. Ryanair's CEO Michael O'Leary will be joining the team from Wicklow in Ireland for that Bloomberg event. This is Bloomberg.